welcome everyone to our in-person guests and our online guests to another CFMG Capital Q&A session. It's the third one we've done in the back half or the second half of this year, and have, to my knowledge, been quite well received by our customers or potential customers. We had about 20 RSVPs for in-person, and I think we've got somewhere around 100 people online, so welcome. You can look at the camera. Welcome to those online. The purpose of these things is an opportunity for investors or potential investors to learn about topics that we think are relevant to them and their investment journey. So previously we had James O'Kane, private client advisor from Shaw & Partners. He did a pretty detailed presentation on general investment or global investment, global equities. Got quite complicated there for a moment. Then we moved on to our most recent one. We had Clive Todd from Mazars international accounting firm, and he got into a lot of detail about SMSFs, the technical details, why the government keeps moving the goalposts. He had some good insights there and some tips and hits on what might be coming in the future. Today we're moving a little bit closer to home, so into the property space, and we've got Angie Zigomanis from Quantify Strategic Insights. Angie's passionate about population and demographics and how they interact with property markets and the wider community. He's got 25 years working across two of Australia's major independent economic and property consultancies, analysing and forecasting property markets. Main focus has been forecasting, and he's worked in public and private sectors. I now hand over to Angie to give his views on how he sees the current property market, given all the constant noise about this subject and the most recent sort of cycle. Certainly during COVID it was going down 30%, did the opposite. It's a good opportunity to learn from a genuine expert rather than the front page of the tabloids or your uncle at the barbecue who will tell you exactly what's going to happen. We've actually got a proper expert here that might give us some better insight into what's going on in the market now and into the future. So welcome, Angie.
Thanks, Andrew. Thanks for the opportunity to speak, and without further ado, I'll make a start. I guess first we'll just start off with a bit of commentary on the economic outlook and the economic environment. At the moment, we've gone through a fairly strong period post-COVID, and as a result of that, there's been a lot of capacity constraints that emerged in the economy, logistics and other problems as well, which has caused inflation to rise. And the Reserve Bank has been looking to get on top of that by raising interest rates to hopefully dampen demand and allow some of that the supply side to catch up a bit. So what we've got here is a bit of some sort of view, on economic conditions, and I've got the outlooks for a couple of the key sort of forecasting bodies, National Australia Bank, the RBA, and also Westpac. And you can see they're probably pretty similar when you look at sort of the general trajectory of the lines after the forecast growth. What has happened, I guess, is that the unemployment, because of the strong economic rebound and also the closure of international borders and reduction in net overseas migration, we've actually seen the unemployment rate drop a lot, and that means the Reserve Bank has been very concerned about what that might mean for wages growth and ultimately inflation. And if you look at the third chart there, the inflation, you can see that's actually been tipping up very strongly in recent months, in recent quarters, and it's expected to peak at about 7 to 8%, depending on who you're listening to, in the coming 1 or 2 quarters. From a Reserve Bank perspective, their aim is to keep inflation within that 2 to 3% range. So what we're seeing is sort of an aggressive uptick in interest rates, and if you look at the last one, the cash rate, you can see that's gone from nearly zero back in April this year, and we're sitting now at 2.85%. So bank lending interest rates have increased the same rate, and depending on who you listen to, the view is they'll peak at somewhere between sort of 3.1 and 3.9%. So that has a big impact on people's borrowing rates, and that has a big impact on affordability as well, and we'll talk through affordability later on. This just highlights, I guess, interest rates. You can see the green line cash rate. This is the National Australia Bank view. So I've just taken one of the banks as the example. But that increase in the cash rate means that you're getting a variable rate sort of getting up sort of 6% plus mark. And if you look at the chart, it probably hasn't been at that level since 2011. So interest rates have been lower for a very sustained period, and this is sort of a big adjustment for the market. offsetting that, we've got the demand side as well. And so up until the onset of the COVID pandemic, Australia was probably averaging about an inflow of about 230,000 people per annum coming into the country every year for the best part of a decade, and that was at a record level. Prior to that, Australia was probably only getting a bit over 100,000 per annum, so it's more than doubling in that inflow. And those people who come here, they need a roof over their heads, they create demand for different sorts of products, so they're beneficial in various ways for the economy. When the pandemic started ramping up, the federal government closed borders. They effectively told a lot of people, look, if you can't get a job here, you're probably better off going home. And so a lot of people did that. And if you actually look at the light blue line there, you can see Australia actually experienced a net outflow of people internationally. So it went from a net inflow of sort of 220, 30,000 to a net outflow of 90,000. So it's turned around of well over 300,000 people just in 1 year. So that had a big impact on property markets at the time. We saw a big increase in vacancy rates, etc. But having said that, the borders have reopened. The federal government had their job summit not that long ago, and they've expressed a desire, I guess, to get overseas migration back up to its previous levels to help support the economy and support economic growth. And so, at the moment, with borders having reopened in November, the net overseas migration is probably tracking to be about 130,000 for the financial year just passed in 2022. And it'll probably get up to past 200,000 again this financial year, the way numbers are tracking. So we're looking at getting back to that long-term level again, and that has implications for the property market going forward. Then when you're looking across different states, there are also different impacts across the states. If you look at the chart, the dark blue and light blue lines, it looks almost black here. New South Wales and Victoria attract the highest proportion of overseas migration into Australia, and they're the ones that had the biggest negative once borders were shut. In comparison, you look at Queensland and West Australia, they also went into negative, but because they weren't coming from such a high level, the impact hasn't necessarily been as great. The COVID pandemic also had a big impact on migration between the states. Prices shot up. A lot of people started shifting their dwelling preferences for affordability reasons. They started shifting their preference location for live, depending on sort of how each of the states responded to the COVID pandemic in terms of lockdowns and other things as well. And Victoria is probably the best example of that, where you can see that sort of dark bluish, blackish line. Victoria was attracting at one stage just under 20,000 people per annum in 2016-17. Where it had the harshest lockdown, it actually started losing people up to sort of 20,000 people in 2021. COVID's had a big impact in terms of where people where people have been choosing to live. And we expect over time that'll sort of get back to where their long-term averages are. But in the short term, it's having the main beneficiaries have been Queensland and West Australia. It's no surprise these have probably been the two most open states, and they've also been the ones that have had the most affordable housing, and so they provide a destination for people to escape some of the strong price rises in houses that have been in Sydney and Melbourne over the last couple of years. If you look at population growth, the chart sort of shows, I guess, that Queensland and West Australia are the ones that have sort of sailed best through COVID because they've had benefits from interstate migration. They've been best supported by population growth, whereas New South Wales and Victoria have dropped off. But having said that, as net overseas migration ramps back up again, we expect population growth to start returning in New South Wales and Victoria back to sort of where it was at pre-COVID levels, with West Australia and Queensland continuing to be strong. One of the other important things to note is also, while we've got sort of population growth coming back, population growth happens at different rates within the population, within different age cohorts of the population. And when you look at people aging through the population, you sort of see three big trends happening. There's three big cohorts to keep an eye out for. One is your baby boomer population. There's a bulging group there. The millennials, and also the children sort of born from the mid-2000s. So this is the Peter Costello baby bonus kids. And you can see that this will have an impact on population growth in different age cohorts. So you can see on the far right, as those baby boomers continue to age, you can see that the 65 plus year old population, the represented by the dark grey line, is going to stay pretty strong over the next decade. What you're seeing now is your millennials, who are aged in their sort of late 20s, early 30s, are going to start entering their 30s and 40s, and in the middle chart you can see in that green line, there's going to be strong population growth taking place in that age cohort. That has implications for property markets, and we probably saw it through COVID, where in that sort of 35 to 44-year-old age group, this is a group where most people are likely to be sort of coupling up, having kids, moving on to the next stage of life. And we often see a big change where people are moving from, living in with their parents or renting, or living with couples, moving on to that family stage and moving to detached housing. And I think that's one of the things that we saw through COVID that's fueled a lot of the movement to regional locations, to new housing estates in the outer suburbs, etc. We've had this huge influx of population now reaching family forming age and looking to buy a house and looking to sort of buy something that's more family friendly. And if you look at the sort of that middle chart over the next 4 or 5 years, that'll continue to be the case as those millennials continue to age into that family forming age cohort. Then if you look at the youngest cohort, the youngest groups, we can say over the next sort of 5 to 10 years, we'll see strong growth in that 15 to 24-year-old age cohort. They're still mostly kids living with mum and dad, maybe going to university, and universities should probably benefit with a lot pick up if you're a university educator, big pick up in domestic students picking up. But beyond that, as they start aging into their 30s, we'll start seeing demand again picking up for rental properties, apartments, etc. So these movements within the population will have implications for demand for different types of property. One of the interesting things that came out of COVID as well is through the lockdowns, we saw people look for more space. Often, we saw families move from apartments to detached houses. We also saw a lot of upgrading to apartments, people from couples in 1-bedroom apartments moving up to 2-bedroom apartments, etc. But that also freed up space as well in 1-bedroom apartments, and we saw a lot of people move out of group households and into to break up and move into homes by themselves. And that was helped by rents falling through that COVID pandemic when international migration fell and rents dropped. So we saw a big increase over the last couple of years through COVID in just single person households. And when people talk about why did the rental market perform so well when international migration was going backwards and population was falling, it's because we had a lot of these single people filling up the gaps, a lot of those group households falling apart. The question is, I guess, going forward is how sustainable is it? And I suppose one of the questions is if you look at sort of how people meet up, get together, move on to the next stage of life. 13% of people met their partner at work, 7% met at a bar. And so if people aren't going back to the office, meeting, socialising, people aren't going out if social distancing means people aren't interacting in the same ways socially at bars and restaurants, etc., as they used to be, then potentially that means people aren't necessarily meeting up, and we could find that a lot of these single people households become long-term occupiers and tenants in the market, and that has implications, I guess, for demand for different types of product like apartments, etc. So just to give you an idea of how each of the states has been performing, how the residential property market has been performing. This gives you an idea of lending, which is sort of a proxy for purchaser activity. And if you look over time, so this goes back over the last 20 years or so, only Victoria through COVID, as strong as the markets have been, only Victoria has actually saw a record level of activity through COVID. Each of the other markets have seen stronger markets through that time. In New South Wales, it was at the start of the sort of 2000s. In Brisbane, it was sort of in the mid 2000s, and in West Australia, in the mid 2000s as well. And if you look what's happening within different buyer cohorts in each of those markets, first chart shows New South Wales, and you can see that upgraded demand, so changeover-wise, people upgrading or downsizing, and first home buyer demand was pretty strong. The interesting thing to note is you look at investors, which is the grey line. Investor demand in New South Wales never got to the peaks that it got in 2014-15. And that's important, I guess, because at the moment, in all the markets, investor demand has been well off where it's been peaking before. And so an environment where there's fewer investors in the market to actually provide rental properties at a time when you've got tight rental markets and you've got net overseas migration coming back very strongly, paints a pretty positive picture, I guess, for rental growth going forward, because you'll have this population growth, but not necessarily the supply that will meet it. Victoria's in a similar boat where we saw a strong increase in owner-occupier demand, and while there's been a pick up in investor numbers, they've been well off. They've been off their peaks as well. Queensland tells a similar story. We've seen a strong growth in upgrader buyers, and we've seen strong growth in first home buyers. They've started to pull back now as interest rates have gone up. Investor demand has picked up, but that's starting to top out as well. West Australia is probably an interesting story. It experienced an almighty boom back in the mid 2000s, in 2005-06. Activity's been pretty solid, but hasn't been back at that level. Interesting for West Australia's investor demand is still pretty solid there, and anecdotally you hear a lot of people who talk about the affordability we're seeing in Western Australia and people looking at that market. The other interesting thing is foreign buyers in properties have also fallen away, and so going back to, there's been a lack of domestic investors, but there's also been a lack of foreign investors in the market as well, and that also will have implications for the next round of property supply and the need to be able to provide the adequate amount of supply to meet population growth going forward. So looking at prices, through the COVID pandemic, we've seen fairly strong price growth. Depending on which market you're looking at, it's sort of anywhere between sort of 20 and 40%. If you go back to sort of the last 10 years or so, Sydney's actually had the strongest growth. It's risen by 141%. Melbourne's risen by 97%. So those two markets have had the longest period of sustained growth, and that has implications for affordability. Brisbane's gone up by 88%, so that's pretty healthy. Perth's only been up by 25%. So there's still been Perth's been sort of fairly moderate compared to the other markets. I've put the forecast in from National Australia Bank to December 2023, so the next 18 months or so. And that's just in there at the moment. They've sort of got a correction in the market of anywhere between sort of the 15 to 20%, depending on which market you're looking at. But I put that in for the purposes of measuring affordability, which is shown in this chart. So this chart measures affordability as mortgage repayments on a median priced house as a percentage of household income. So the higher the peak, it means the less affordable property has been. So for some of the older people here, you can see that affordability is at its worst in a lot of markets back in 1989, back when interest rates peaked at 17%, which is nowhere near where we're at now. And even though it's nowhere near where we're at now, you can see that affordability in particularly Sydney and Melbourne is at its worst level since that time. So that's come about because you've had obviously the strong price growth post-COVID, and now we're getting the rising interest rates, which are sort of exacerbating those affordability challenges. And even with that softer market predicted by National Australia Bank, you can still see affordability a bit more challenging in those markets. In comparison, Brisbane and Perth, even with those interest rate rises and strong price growth, affordability is still a bit more manageable in a long-term sense. And so those affordability questions, I guess, will be there for the market going forward. If you look at unit price growth, apartment price growth, it hasn't been as strong. It's been a lot more moderate than most of the markets. That also means that the gap between unit pricing and house pricing has widened, and that creates a bit of opportunities for people to look at more affordable options, such as townhouses and apartments rather than houses where affordability may be more stretched. Now, importantly, it's worth looking at vacancy rates, and you can see since the COVID pandemic, vacancy rates have tightened across all the capital cities. You can see Sydney, through the pandemic, vacancy rates peaked at 4%. If you look at the purple line on the far and vacancy rate on the far right, but they're now down to just over 1%. Melbourne experienced a peak in vacancy rates of nearly 5%. It's down to 1.3 or 1.4% at the moment. So they've all tightened a lot. Brisbane, vacancy rates have fallen below 1%. And if you look at Brisbane, they didn't experience the big boost in the big uptick in vacancy rates that we had through the COVID pandemic that Sydney and Melbourne experienced. And that's part of the reason because part of the reason for that is the Brisbane market actually had a period of higher vacancy rates earlier on, and it took a while for that to be absorbed, but it was fully absorbed coming into COVID, so we didn't get that, and Brisbane didn't have those same COVID population impacts that Melbourne and Sydney had. So Brisbane's been tighter for longer, and Perth's the other one that had strong rise in vacancy rates through the sort of late 2000s. It's tightened up a lot now. The vacancy rate is sort of 0.8% or something like that. So all these markets are very, very tight now, and that's positioning them for strong rental growth going forward. And these charts give you a bit of an idea of what rents look like. There's probably the rental market's sort of been bifurcated, so split in two. Through COVID, we saw initially stronger growth in house rents, and that's because through the COVID pandemic, we saw, because of the need for social distancing, etc., we saw a lot more movement in towards space, and so there's a lot stronger demand for detached housing. And you can see by the dark blue line, both Sydney and Melbourne have continued to experience strong rental growth in the last couple of years. In contrast to the apartment market, because of the outflow of overseas students and overseas migrants, that the rental market took a hit. Depending on which market you're looking at, Melbourne rents fell by nearly 30% in some areas. Sydney's fell by just over 20% in some areas. But having said that, we're now starting to see a big turnaround in rents. We've got the combination of single person household backfilling some of that stock, and now overseas migration coming back and starting to fill it in. And so if you look at Sydney and Melbourne markets, they've probably come back by 10% over the last 6 months, and there's this pretty much strong growth sort of baked in now based on just limited supply going forward. In contrast, the Brisbane and Perth markets were both tight through COVID. You can see they didn't experience a correction through COVID, and have had strong rental growth over the last couple of years, and that's still expected to continue to rise going forward based on those lower rents, based on those lower vacancy rates. The interesting thing is, with those rents now starting to rise, and we're having and prices flattening out and starting to fall back, yields are starting to increase now for property as well. So if you look at both Melbourne and Sydney, particularly house yields, they followed interest rates down. But over the last 6 months, you can see yields are starting to pick back up. So returns for investors are starting to improve.
Is that discount investor rate tax adjusted?
No, that's just the typical discount on the standard variable rate that a bank's going to give you.
Right.
Okay. And you can see yields are a lot more attractive in Brisbane and Perth, which you'd expect. And in some cases, like Perth, relative to interest rates, they're still pretty healthy. And so we think that'll start bringing some investors into those markets. The other thing we look at is supply, the supply side. So this is new dwelling building approvals. So this is approvals for construction. And you can see the Sydney markets, you can see the apartment market and construction peaked back in 2016, and it's fallen away dramatically since then. So there's a much lower level of building going on now than there was a few years back. And even the case in Melbourne, you can see the same thing. Particularly apartments have fallen back. Detached housing has been stronger. That's starting to fall away as well. But overall building has fallen away in Melbourne as well in total dwelling terms. Brisbane's the other one where you can see it had a very big peak in apartment development back in the mid-2010s. And new activity's been low for quite some time now, for the last 5 or 6 years. Detached housing's been up, and Perth's the other one where we had a big uptick in detached housing activity. But the reality is, new dwelling activity's been down, is well down on where it was back in the mid-2015, 2016 period. So across all the markets now, we're going through a period where new dwelling building's starting to fall away, and that has implications for supply, for completions and new stock being added to the market, particularly at a time when we've got an uptick in population growth coming through again. This is more specifically the apartment market, and it gives you an idea of, I guess, this is as provided by Charter Kramer, and it shows you the apartment pipeline in terms of completion. So this is the number of apartments expected to be completed over the next few years. You can see, Sydney went through its big apartment boom up until about 2020. Activity's fallen away, and the current pipeline means activity is going to be well below previous levels for the next few years. The interesting thing is you can see that some of the pipeline's been pushed out as well because of COVID and delays in construction. So whereas a lot of the stuff that's scheduled to be completed in 2023 was probably originally going to be completed within the last 12 months, but it's been pushed out. But either way, if you're going into sort of 23, 24, 25, the pipeline indicates that there's just very little new stock coming online. And this is the case across all the markets. You can see Melbourne's well down on where it was up until 2021. Brisbane's well down on where it was up until 2017 and 2018. So the whole supply story is a lot more constrained going forward, particularly in the apartment sector. Even Perth has got a bit of a pipeline going through, and it's probably a bit more healthy, but it's not a big apartment market. The other challenging part for the market is also construction costs, and that's also having an impact on the next round of construction. If you look at all the capital cities and just look at the last there's huge uptick in construction costs at the end of all those bar chart, at the end of all those line charts, just showing how much construction costs are increasing. That has an impact on affordability. That has an impact on development feasibilities as well. And so, if you're a developer and you're selling product at a certain price, but costs run away from you, then you'll pull that product off the market unless you can get a price increase, because it's not worth your while to develop, to profitably develop. And that's the case in all the markets. It's becoming a lot more challenging in a time when price growth is now flattened and is falling away. It becomes a lot more difficult for the next round of developments to stack up, and for the next round of projects to proceed. So that just means the market becomes tighter and tighter. This looks at some of the land market story as well, and just give you a brief outline across the charts. The left one shows land price growth plus house price growth. So it's construction costs for new houses. And you can see over the last couple of years, both of those have increased dramatically. That's increased the cost of new housing. And if you look at the middle chart, it shows that the price of new housing relative to established housing, and that grey bar shows the ratio of new housing to established housing. So it shows that new housing has now started to become less and less affordable versus established housing, which in turn means that for a purchaser, established housing becomes more attractive. But also, if you're an upgrader in the market, it also means that it becomes more difficult to trade out of your existing house to upgrade to a new house, because that gap widens. And you can see that affordability issues have had an impact on land sales as well, which have started to fall on the right chart, shown by dark line, which is starting to fall away a bit. So these have implications for the market as people start to sort of readjust their decisions looking for affordability. Melbourne's in a similar boat. You can see on the left side, both of those construction costs and land price growth has been sort of fairly strong over the last couple of years, and it's made obviously new house prices more expensive. One of the other things to note, I guess, is that we've gone, and if you look at the chart on the right, Melbourne, for example, the dark line there shows lot sales. It was at record levels, and so there's been a big backlog of product that's there waiting to be developed, because most of it gets sold off. A lot of it gets sold off the plan in Melbourne. And so what developers have also done is have stepped back from the market and taken the opportunity to sort of ration demand by raising prices as well, to help manage those increased costs at a time when they still have a big backlog of product that can still push through and settle on down the track. Brisbane market's also been fairly strong. We've seen solid growth in construction costs and house price growth as well, and land price growth as well. It's been a market where established house prices and new house prices have sort of been fairly on par with each other, but that gap has sort of widened a little bit now.
Well, that slide's pretty relevant to us.
Yep.
You'll see the construction prices going up, particularly the average build cost. So we went through a period through 21 in particular, where on any given weekend we were raising prices of our land almost to stem the flow of sales, which is, people might find it strange, but while we're constructing, if we sell our land 6 months before we finish construction, when we could have sold it 1 month before construction, and prices are increasing on a month by month basis, we're giving away that margin to the buyer who buys 6 months out. So for a period there, we continually raised prices on our land and continually would sell out that weekend and then try and go again and go again. But now we've reached sort of critical mass where house prices have gone, well, construction price for the house that they're going to put on that vacant block that we deliver have reached such a level that we can't raise our prices any further because everyone's got an affordability limit when you put the house and the land together. So that's what's, more than anything, that's what's moderated land price growth. Is there's still the demand there, but it's actually the cost to put the house on it that's moderating the land price growth in the last sort of few months.
Yeah, and there's it's from a construction cost perspective, you're at the whims of the builder. What they're going to charge.
Builders are operating off a margin-based model. So what it costs them to build the house, they put a margin on top. So they're not getting driven by demand. So if demand's really high, they don't make their house more expensive to build. It's just, if their trusses cost X amount of dollars, their bricks cost this, their slabs cost this, they add their margin on top and that's what it costs. Land prices, we drive at what someone's prepared to pay, that's what we'll put it at. We're not driven by someone putting their price up on us. We're prepared to sell it for whatever price someone's prepared to pay. So our movement is more constant.
Yeah. So what you're saying though is if they've got a fixed margin on construction costs, you're actually improving your margin as the land values went up until
Absolutely.
you hit that critical point.
Yeah. The other thing to note is, the other thing to note is construction costs do go up and down. In land development game, often you'll find your land price gets to a certain level, you can correct it to some extent, but you don't necessarily want to drop back too far because that affects investment value of the development. But construction costs do respond to market, and if you look at the charts here, you can see there's periods when it's been negative as well. At the end of the day, the stories here, brickies are getting $2.50 per brick. But in a weaker market, only getting $1.50 per brick, sort of thing. So labour costs do vary, materials costs do vary, like a lot of building costs do vary, and so the construction side of the equation can correct more so with the market than land does.
And with the lot sales, I can't remember what might have been one. That one there, lot sales versus affordability.
Yep.
Certainly in the last 6 months for us, we've gone from competing with other land developers to competing with existing real estate, because when the market gets to a point that it is like now, all the sort of, not cowboys, but the inconsistent developers that aren't running through all the cycles, they disappear out of the market. So we've got projects in some corridors where we're the only active land estate, and there's plenty of demand there, and our competition's not another land estate, it's someone going, oh geez, I'm a new home buyer. There are people that are either a new home buyer and existing, they don't look either way. But those new home buyers are thinking, I can buy something 2 or 3 years old for a little bit less. You always get to pay a premium for new, but our competition is existing stock as opposed to other developers. And that's been a shift in the market.
Yeah, and often you'll see that when prices get pushed. Perth market's had a similar effect. It hasn't had the big increase in land prices, but that's also because it hasn't had the big increase in total in established house prices either. And as Andrew said, if you look at the building side of the equation, that's shot up a lot, and so the builders have sort of absorbed all the price growth in the housing market, and it means that the developers, the land side of it, can't capture as much. But yeah, so the Perth story is similar to the others. Obviously, affordability has become more challenging. The interesting thing for Perth was when COVID just started, there were stamp duty concessions, there was government bonuses, there was everything else. I think at one stage the bonuses all added up to something like $70,000 on a house and land package where you're buying land for, you know, 215, 220,000 at the time. So it was a huge incentive, and you can see the way sort of land sales in that last chart shot up and then corrected a bit once the incentives fell away as well. So those incentives also played a bit of a part in sort of how the market reacted. So when you put it all together, obviously we've got rising interest rates, we've got affordability challenges starting to come through. They're going to be most acute in Sydney and Melbourne. They've both had the strongest price growth, and they're the ones where households are most extended already. So they're the ones that are going to be most affected. Brisbane and Perth started from further behind in both of those markets, and they're in a better position now to weather the current cycle, and also probably position themselves for the next cycle as well. If you're looking at sort of different segments of the market, so those millennials have been driving the land market. And to some extent, they're still going to be there because they're still in that household formation stage, and they're still going to be there for the next 5 or 6 years. Affordability will make things more challenging for them, and they'll probably start to look to compromise. And we're seeing that with developers as well. Like in some of the housing estates, some have opted to develop small lot product, or they're seeing some of the demand shift towards townhouse type developments within the states as well in some of the markets. So we're seeing that, and we expect some of that demand will move into apartments and other things as well. So there'll still be demand for those sort of affordable products. There's also be some demand, I think. There's still a big gap between detached house and apartments, and we've seen a bit of downsizing activity take place as well. And using my parents-in-law as an example, they moved from a half acre detached house into a house on a standard size block on a new housing estate as part of that downshift. And I think there'll probably be elements of that going on there as well, just because that gap is still there. Going forwards, we expect vacancy rates, and we expect the vacancy rate story and the rental growth story to still be there for at least the next couple of years, just because it does take a long time to turn around supply. If you're developing and building apartments, etc., it still takes a good couple of years to get that supply on the line. So supply on the ground. In the meantime, we've got net overseas migration roaring back, and so we think those stories about tight vacancy rates, about rising rents will still be there. Yields will start to pick up, and you'll start seeing investors come back into the market as well. Construction costs obviously have been going up. There's a big backlog of activity still working its way through, but as that starts to dissipate, sort of 12 months out from now, you'll start seeing construction costs start to ease, and that starts creating opportunities for the next round of whether it's development for buyers as well, where product becomes a bit more affordable. It's probably potentially a time to sort of start looking at new products based on that sort of more benign construction cost environment.
What do you think with the super fund getting into build to rent? What do you think about that?
Oh, it's interesting. If you saw the charts before, it's back in sort of 2015, 16, there was huge levels of investor demand across all the markets. There was huge levels of overseas buyers buying in those markets as well. They were all supplying a lot of retail's investor stock, I guess, so to speak, on the market. And if you go through that time, you look at it and say, well, the vacancy rates didn't rise a lot in that time, even though, and that was partly because we were getting 230, 240,000 people per annum coming into the country, filling that stock up. Going forwards, investor levels are much lower. I don't think overseas buyers are going to come back to the same extent that they have, because most of the governments sort of tax them out of the market. And so you're sitting there saying, well, how do we meet that supply that's needed? And the only way you can do it is by replacing some of those overseas funds with institutional funding to supply that stock. And so I think that's one of the reasons why you're seeing a lot of people come in there, because the story is starting to become more compelling for them from an investment perspective. Because we do need to be building 200,000 plus dwellings per annum to house overseas migration of 230,000 per annum. Any other questions?
What's the effect of China? Obviously COVID, well, there's zero COVID positive had a big impact on inflation because that limited supply.
Yep.
And whether it was contrived or not, I don't know. But what do what's your crystal ball saying about China? Whether that's are they going to loosen the reins?
Your guess is as good as mine. There was, I think it was about a week ago, there was a rumour that that they were going to let loose or have some sort of framework for reopening, and share markets went up and everything else on the expectation, and then the government shut that down. I think not long afterwards. So if you take that as a guide, I guess it means they won't. But it's hard to say, as you said. It's that's creating its own economic issues for the country, for the country itself. Obviously, that has implications for Australia as well, because it impacts probably overseas migrant movement into Australia, investment and other things as well. So that there are implications there for Australia in that context as well as for China itself. Any questions off the net?
Any questions for me about unrelated to the presentation, I guess?
Well, I guess you've painted a pretty positive picture for Queenslanders. I think is the overarching message that I certainly have received. I'm not sure if that was not necessarily your intention, but that's what the data seems to produce.
Look, Queensland would probably be the pick of the markets.
Yeah. With population rising, vacancy rates are through the floor.
Yep.
Undersupply, construction non-existent.
Yeah. You could add probably economic tailwinds coming from Olympics investment as well.
Of course. The only headwinds you've got are the global forces of interest rate inflation, etc., which, depending on once again which commentator you look at, seem to be levelling out potentially.
Yep.
So I guess it's not necessarily a question. I guess it's a comment that in terms of investing in Queensland and this type of investment as opposed to the other states, I think we're probably in better shape.
Yeah. Look, it said, sort of says on the first slide, I guess, Queensland and Western Australia are probably the ones best positioned to go into the next cycle going forward. Sydney and Melbourne probably, then if you look at that affordability chart, still have, I guess, a bit more affordability issues to work their way through. At the end of the day, everything's cyclical as well. They'll turn to some extent as well, but there's more upside, I think, in Queensland and Brisbane and Perth as well.
I'm going to be very intrigued. I mean, you put a red circle around the NAB forecast of property stuff, and are you a Stephen Keane advocate, or are you? I'm going to be very interested to see what plays out.
Yeah, it's
and
interesting.
We're all polishing our crystal balls, of course.
Yeah, it's interesting. I mean, if you look at sort of going through sort of the 70s and 80s, etc., where you had sort of a much higher inflation, higher income growth environment, what you'd find is prices would stabilise a lot more, because the price would sort of get to a point and then stop for a while, but inflation would eat away at values in that time. If you're in a low inflation environment, then market prices probably correct a little bit differently, and they probably have to correct in numerical terms rather than staying flat for a while to some extent. And we saw, if you go back to the price chart, I mean, even when sort of 2015, 16, 17, when APRA started sort of instructing banks to tighten lending policy, we actually saw Sydney prices fall by, I think it was about 15%.
Yes.
And so I think, that's how the mechanism probably works a bit more, might work a bit more in a sort of a lower income growth, lower inflation environment, rather than sort of having inflation eat away at a lot more quickly.
Yes. So access to money back then was harder in a low inflationary environment. Yeah. Whereas it's the opposite.
Well, but it's I think access to money is getting more difficult though. Banks. So banks. Well, banks sort of instructed to provide a 3% buffer on top of whatever the rate they're assessing at. That rate's now a lot higher, so it becomes a lot more difficult for a bank to give out that money. The other things may be affecting might affect households as well, is a lot of people probably, through COVID, were getting loans on sub 2% rates, which are probably going to roll over in the next 12 months as well. So it'll be interesting to see what, how those households are affected once it does roll over. Because we're at the point now, I think, instead of variable rates, the cash rates are 2.85. If it gets to say Reserve Bank, NAB was I think 3.9%. That's the 3% buffer already eaten up there. So anyone who sort of took it, anyone who the bank might have assessed at a 3% buffer, it's probably been blown out of the water now.
Yeah, I mean, we were seeing 12 months ago, there was pockets where the rent was about 20% above what the repayments would have been for someone in that same location.
Yes.
Even at a 90% LVR, because the rates got so low on a entry level property, but yields were going so high that your repayments on a property might have been $300 a week, but the person renting it was paying $450 a week.
Yeah.
So what we know is first home buyers love a crisis. So you go back to 2008 and you come to the most recent crisis equals low rates and stimulus. Stimulus removes the biggest barrier to entry with the deposit requirements, because a lot of banks find ways to treat the stimulus as your deposit, and suddenly you get flooded with first home buyers.
And is that your wheelhouse?
We certainly benefited from first home buyers in the last 18 months, but we're happy to keep the investors fed. And as the data says, investors is where it is, because you've got demand for accommodation with the migration, so interstate migration into Queensland, but now the rebooting of overseas migration. There's going to be demand for new properties. First home buyers are obviously owner occupiers anyway, but you still need to build the properties. So those investors from Sydney and Melbourne that are buying in Brisbane, that's our wheelhouse for the next sort of 6 to 12.
Right.
And as Angie said, those people are looking at those affordable markets being Brisbane, Perth, and to a lesser degree Adelaide.
Right.
The other interesting thing I was to say is also, if you look at the forecasts for the forecast for unemployment was most we were sort of talking high fours rather than going out to sort of 5, 6, 7% where it could be. And one of the reasons behind that is if you look at the far left chart, which is and the dark blue line, which is the 25 to 34 year olds, you've actually got weak growth going there for still the next 4 or 5 years, even though you've got all this overseas migration coming back. If you actually took out overseas migration, that growth would be negative. And so, but these, in that age cohort, you're looking at new entrants to the workforce, new graduates, etc. And with those low numbers coming through, it means your actual labour force doesn't grow as much going forward as well. So I think that's one of the factors sort of behind why unemployment rate stays a bit lower, because you're not necessarily getting that big growth that you were getting sort of the last decade when all the millennials were starting to enter the workforce.
Do you think government taxes have an effect on investor demand for land-based investment, or how? Like I was put it personally myself, land tax and all the other taxes is not as attractive anymore as it used to be for property, especially that property's gone up and they haven't changed the thresholds. So once you start hitting those thresholds, you sort of start paying taxes, which make it hard to compete in the rental market.
Well, you add sort of, I guess, when interest rates were lower, prices went up, people were happy to accept lower yields as well, and probably try and offset against that the hope for capital growth. So, based on lower yield, and sort of any sort of outflows obviously were eating away at that pretty quickly. But going forward, I think we probably get an environment where I think the banks have realised how sort of silly it was to keep interest rates at such a low level for such a sustained period, and I don't think we'll necessarily see interest rates go back to that level. So as I think we see sort of rents go up, yields go up, I think they will settle at a higher level, which hopefully then starts offsetting some of those land taxes and other things to a greater extent.
How will it affect investors if the government introduces or changes the negative gearing? Because there's talks they won't, will they?
Yeah. Oh, well, I mean, there's always challenges with those things. presumably you'll have fewer investors in the market, which then starts obviously affecting the next round of investment product that comes into that gets built and meets demand. So theoretically, you'll see vacancy rates stay tight, rental growth continue to rise, unless you start seeing instead of institutional funds moving into that market. To some extent, retail investors are happy to take a lower yield because they are getting that negative gearing benefit.
I don't think either side will have the courage to do it, even if they should.
Not for a while, anyway.
Certainly not in the current
Current term.
terms, or probably the next 3 or 4 terms, I'd say. But, maybe they should, but they definitely won't. I got a question online that I just sort of sought some clarification. Looks like it's directed mainly at me. It's come in a few parts. Where in Queensland, how are your projects making sure we capitalise growth? Like clarified, do they mean price growth or growth in migration? They've replied property growth or looking to invest in one of your funds doing development. So I guess the short answer, well, I'll give a long answer. The answer is, and it's a presentation I've sort of done a few times, is when the market's growing or there's price growth, that's probably benefits us as a business more than our investors, because our investors through the history of our business have been paid a return that we fixed at the time of, or targeted at the time of advertising. We've never missed that targeted return. But when the market grows and there's a boom cycle, that's when we're benefiting the most. So we might buy a project and we say, okay, this project works with our feasibility model. If we sell 100 blocks at $200,000 each, and we'll be able to pay our investors, make a significant or an acceptable profit for us to continue to run the business. If we then see a market cycle where we don't have any cost growth, the price growth is up to 250, and we sell 100 blocks, well, that's cream for us.
Yeah.
So we're not relying on a growth market for our developments to deliver returns to the investors in those markets or in those funds. Those we're not targeting a growth cycle. Don't get me wrong, we like them, but that's not what investors are investing in. They're investing in our ability to deliver a project take a project and improve the outcome. So value add through development, and then that's where the growth, or that's where the return comes to investors. Yeah, so we'll buy a site, and we don't build. We think it's going to go up 20%, therefore we can buy it. We can't take that kind of risk. But if we buy it and it goes up 20%, great. That's great for us. Doesn't affect the returns for our investors at all. Their returns remain the same.
When you sell your lots, do you do it through partnership, or do you just sell yourself directly?
We've changed over time, but in our current model, we have 3 on-site or permanent sales guys. So they're assigned to projects or multiple projects each. So they sell direct. They work directly for us. They don't work for real estate agents or anything like that. Directly for us, direct to the public. But we also have what's called a business development manager, and he would sell into. So we might partner with a builder, and they'll sell to.
They have a package.
Yeah, packaged into someone in Sydney, or through someone that runs wealth building seminars, that kind of thing. They'll sell through there. That's what's called channel sales. We do all of that internally. Got another question. This one might be I'll go for the first one. This one might be for you, Angie. What are your thoughts on the impact of short-term rentals on East Coast on long-term rentals? Councils are active in limiting their influence. Comments, please.
Yeah, well, I suppose anything you put into the short-term rental market takes the product out of the long-term rental market, which obviously impacts your typical sort of future first-home buyer renter or families or whatever else. So obviously that has an impact. In cities as big as Melbourne or Sydney, I'm not sure if it has as big an impact, but you probably are seeing a lot of regional areas where there are big holiday markets as well. I suppose one of the things that's sort of come out of COVID is a lot more people are holidaying domestically nowadays and driving holidays or short trips, and so that's sort of inflated demand in a lot of the regions, probably over and above what it would otherwise have been in a sort of more normal environment as well. So, and where there's a lot less stock, I think that's where you probably find the biggest impacts have been. And when you probably look at some of those vacancy rates, obviously a bit tight in the capital cities anyway, but they've sort of been ultra tight in a lot of the holiday areas.
I'm just replying online. It's easier for this one because any more? That's great.
Do you do any investment in commercial space or just residential?
Just residential. We've toyed with the idea and it's not completely closed, but at the moment we'll stick to what we know, I think. Yeah. I think we'll wrap it up there. Goodbye to our online viewers.
Thank you.
So,
That's finished my